JP Morgan can't reduce its balance sheet as such. What it can do, well, I mean, it might be able to on the margin, but it would be catastrophic for the US banking system. All they can do is move out of risk. And so, they're basically what they've done is they've gone out and they've bought US T-bills 3, 6 months, probably at a stretch, even 12 months, but I think probably mainly 3 and 6 months. So the funding of this deficit is a rolling problem, as it were, which is only getting worse because it's the average duration of US government debt is declining and declining and declining. And that's a very dangerous situation.
The head of the International Monetary Fund recommends that the Federal Reserve postpone cutting interest rates until at least the end of the year. This advice comes as the U.S. stands out among G20 economies for achieving growth above pre-pandemic levels, with robust economic performance indicating ongoing risks of inflation. The Fed has maintained its Fed funds rate between 5.25% to 5.50% since July 2023. However, the Fed faces a complex situation. On one hand, it must manage U.S. government debt and support economic growth through monetary policy. On the other hand, there is significant dependency on global financial flows, particularly from Japan, crucial for funding U.S. debt. According to financial analyst Alasdair Macleod, Japan's central bank, the Bank of Japan, is under pressure to raise interest rates. This pressure complicates matters for the Fed as Japanese financial institutions, including banks and pension funds, traditionally hold substantial amounts of U.S. government bonds. Recent losses have made them increasingly hesitant, and they may consider selling these bonds. Simultaneously, U.S. banks are becoming more cautious, reducing risk exposure by shifting investments towards short-term U.S. Treasury bills. This strategy aims to mitigate potential losses and secure more stable investments. Moreover, the average duration of U.S. government debt is shrinking, necessitating more frequent refinancing within shorter periods. This trend increases the vulnerability of the U.S. government to fluctuations in interest rates and complicates its debt management. The IMF underscores that high deficits and escalating debt pose growing risks to the U.S. and global economy. These factors could increase fiscal financing costs and complicate the smooth rollover of maturing obligations. Therefore, any premature reduction in interest rates by the Fed could exacerbate these funding challenges, making it more challenging for the U.S. government to effectively manage its debt obligations. Now, we present the clips of Alasdair Macleod's insights from his recent video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
It's got to fund the US government's debt, or it's got to run a monetary policy which is consistent with that. And I think that any sign that it's going to start reducing interest rates, and you'll find that it just makes that more difficult. I mean, as I said, I think that the carry trade out of the yen is getting more and more important. The Bank of Japan is being forced extremely reluctantly to raise rates. The Fed is talking to the Bank of Japan and saying, I think, you don't need to raise rates. Keep them low, oh boy. Because what they want this, they're becoming dependent on this carry trade, I think, to finance US government debt, because the foreigners, China's not buying. The Japanese institutions aren't buying, that is for sure. There may be some still doing a carry trade, but I think as far as the carry trade is concerned, I think it's mainly US interests which are shorting the yen in order to buy US treasuries. It's T-bills rather than anything. This is all very short-term stuff. So I think that is one reason, and a very important reason, why the Fed is delaying on the cut in interest rates. And as I say, we have this situation where the banks are over leveraged. And just listen to Jamie Dimon. He's made it quite clear that he doesn't want to expand his balance sheet leverage anymore. If anything, he wants to reduce it. So JP Morgan can't reduce its balance sheet as such. What it can do, it might be able to on the margin, but it would be catastrophic for the US banking system. All they can do is move out of risk. And so, they're basically what they've done is they've gone out and they've bought US T-bills 3, 6 months, probably at a stretch, even 12 months, but I think probably mainly 3 and 6 months. So the funding of this deficit is a rolling problem, as it were, which is only getting worse because it's the average duration of US government debt is declining and declining and declining. And that's a very dangerous situation. But the Japanese institutions, of course, are looking like turning sellers. You had this central bank for the farmers and fishermen declaring that they had made enormous losses on their foreign bonds and all the rest of it. It's interesting because the losses aren't on the currency. The losses, I mean, we don't know whether they hedge the currency or whatever. I doubt it, but they've got the losses on the bonds. So, I think that virtually every bank in Japan, and also the insurance companies and pension funds, if they leave anything in US dollars, it's going to be very, very short term. So, this is not something that leads to wholesale selling of dollars. But if the Fed starts reducing interest rates, then I think it's going to make its funding problems a lot more difficult. So, other central banks like the ECB don't feel that sort of pressure because they're not responsible to any one government. So I think that's the fundamental difference, if you like, between the two.
Gold's value stands in stark contrast to the dollar, which relies largely on trust rather than inherent worth. This distinction becomes crucial as concerns about currency depreciation become more pronounced. China has been leading the charge in global central bank purchases of gold, reaching record levels in the first 9 months of this year. Their goal is twofold: to hedge against inflation and reduce dependency on the US dollar. The World Gold Council reports that China alone has accumulated over 300 tons of gold, valued at approximately $561 billion in the last 18 months. This significant accumulation has not only fortified China's reserves, but has also influenced other BRICS nations to follow suit, opting to bolster their gold holdings instead of relying solely on the dollar. In China, Alasdair sees that banks play a critical role by offering accessible gold accumulation accounts that require minimal deposits, typically around 500 or 600 yuan, approximately $80. This approach enables individuals to safeguard their savings in gold, putting pressure on banks to secure physical bullion to back these deposits. While these actions may not have immediate widespread visibility, they underscore the underlying factors driving the upward trend in gold prices.
If you look at the charts, this is what everybody does when they don't understand what's going on. Look at the charts, and you can see there's been a long consolidation period, so the breakout was bound to be, pretty dramatic. Dramatic initially, and again, talking purely in charting terms, it's the start of a new bull phase. So that's where we are. I think what we've seen sort of part one of the new bull phase, that was a run up to 24.45 or whatever it got to. We're now consolidating that, and we've been consolidating that for the last 2 months or so, 2 or 3 months. And at some stage, that consolidation will end, and off we go. But as I say, what it's actually about is the declining purchasing power of the dollar, which we're talking about when we look at the gold price, or if you like, the dollar priced in gold, that's going to continue to decline. I mean, what gives the dollar its value? I mean, we're talking about bits of paper or units on in some sort of electronic account. It's just faith in it. It's just faith. That's all it is. What gives gold its value? Well, you can actually hold it, and it's legal money. This is the point. I remember when we were, when you very kindly invited me to talk in Frankfurt. I made this point to the invited audience, and I don't think people understand this point enough. So gold will continue to appear to rise, but actually what's happening is that its fiat currency is falling. But there is another element to this now, and that is that I think the understanding of this is going to widen, and particularly amongst Chinese savers. The point is that the Chinese, as a nation, are a saving nation. It's estimated that Chinese households save 35% of their income. Now, 35% of their income is around about $6 trillion on Chinese GDP. So $6 trillion, where does it go? Property? Yesterday's story. Stock market? Not really. It goes into bank accounts. and it goes into gold. And I think it's going to increasingly going to go into gold and also silver, because Chinese individuals can't go and buy foreign currencies or foreign stocks or anything like that. They don't have these avenues which we have become accustomed to. Whether the avenues are good or bad, it's a secondary question. But as far as the Chinese individuals are concerned, their banks will offer them the facility to deposit money, currency, yuan, in yuan accounts, or alternatively in gold accounts. And as long as you've got a minimum of about 500 or 600 yuan, which is what, about $80 or something, you can open a gold account and you can accumulate your savings into that. What does the bank do? Well, the bank has to go out and cover these liabilities. Now, it might do it on a fractional reserve basis. I don't know, but I doubt very much that that's going to be the case. I think they will try and back it with physical bullion as much as possible. Of course, we don't see this necessarily because the accumulation of gold reserves, say that any of the major Chinese banks, will be in the Shanghai Gold Exchange vaults. So this isn't going to be delivered to the public, which incidentally has already delivered something like 27,000 tons of gold into the public. So, this is gold. This is why gold is moving. The pricing of gold has actually moved to Shanghai. We're just dealing in sort of paper, which pretends to be the real thing. But it's not. It's not. So these are interesting times, if I can say that. As the Chinese would say, live in interesting times.
Delaying interest rate cuts until year-end could stabilize U.S. economic growth and mitigate inflation risks. However, challenges persist with managing U.S. debt amidst reliance on global financial flows, especially from Japan. Meanwhile, rising gold prices amid economic uncertainties may alter market dynamics, impacting monetary policy decisions. Comment below on how these economic challenges might influence future monetary policies. Like, subscribe, and turn on notifications for more updates. Thanks for watching.